In this video, we will explore how you can apply Buffett's investment strategies if you are starting with $100,000. Many people feel overwhelmed when starting with limited capital. With 100 grand, it can be difficult to know how to allocate that money wisely without making risky or impulsive investments. With that being said, Warren Buffett's advice offers reassurance. Whether you are a seasoned investor or just beginning your financial journey, there are valuable lessons to be learned from Buffett's approach. Let's get started. Understanding value investing. Value investing is an investment strategy in which investors aim to buy stocks, bonds, real estate, or other assets for less than they are worth. This approach is significant in wealth creation because it allows investors to buy quality companies at a discount, setting the stage for substantial long-term gains. Warren Buffett, a staunch advocate of value investing, emphasizes the importance of thorough research and a disciplined approach to investing. One of Buffett's most notable successful value investments was in Coca-Cola. In the late 1980s, he recognized the brand's strong market position and growth potential, purchasing shares at a time when the stock was undervalued. Another example is his investment in American Express, which he bought during a crisis when the stock price plummeted. Both investments exemplify Buffett's strategy of identifying quality companies with long-term potential, reinforcing the principles of value investing that can lead to a significant wealth accumulation over time. As we can see, Buffett identifies undervalued companies by analyzing their financial health, competitive position, and growth potential. He looks for businesses with strong fundamentals, such as consistent earnings, robust cash flow, and a solid management team. By focusing on companies that are temporarily undervalued due to market fluctuations or negative sentiment, Buffett positions himself to capitalize on their eventual recovery. If you enjoyed the video, hit the subscribe button and comment your thoughts. If you want to explore money-making strategies, click the link in the description to start your financial journey. Building a diversified portfolio. Diversification is a crucial component of any successful investment strategy, as it helps to spread risk across various assets. By investing in a diversified portfolio, you can reduce the impact of poor performance from any single investment. This means that if one stock or sector underperforms, the overall portfolio may still thrive due to the strength of other investments. Warren Buffett, well known for his concentrated investments, also recognizes the importance of diversification in mitigating risk. Buffett's approach to selecting a mix of stocks involves investing in companies that he understands well and that have strong fundamentals. He often emphasizes the need for a balanced portfolio that includes a variety of sectors to cushion against market volatility. For instance, Buffett has historically favored sectors such as consumer goods, financial services, and healthcare. Companies like Procter & Gamble and Bank of America are prime examples of his strategic selections. By diversifying across these sectors, Buffett not only reduces risk but also positions himself to benefit from different economic cycles. This balanced approach allows investors to capture growth opportunities while minimizing potential losses. Ultimately, a well-diversified portfolio can enhance long-term returns and provide a more stable investment experience, aligning perfectly with Buffett's investment philosophy. Investing in quality companies. Investing in high-quality companies is a cornerstone of Warren Buffett's investment philosophy. In Buffett's view, a quality company is characterized by strong fundamentals, consistent earnings growth, and a durable competitive advantage. These companies typically have a solid business model, a strong brand reputation, and the ability to generate cash flow even in challenging economic conditions. Buffett has invested in several companies that exemplify these qualities. For instance, his investment in Apple reflects his belief in the company's innovative products and strong brand loyalty. Similarly, his stake in Berkshire Hathaway showcases his commitment to quality, as the conglomerate owns a diverse range of high-quality businesses. Other notable investments include Coca-Cola and American Express, both of which have demonstrated resilience and strong market positions over the years. By focusing on quality companies, investors can build a portfolio not only withstands market fluctuations, but also has the potential for significant long-term growth, aligning perfectly with Buffett's investment strategy. Long-term investment mindset. Adopting a long-term investment mindset is one of the most significant strategies advocated by Warren Buffett. He firmly believes that holding investments over time allows investors to ride out market volatility and benefit from the inherent growth of quality companies. By focusing on the long-term potential rather than short-term fluctuations, investors can avoid the pitfalls of emotional decision-making and market timing. One of the most compelling reasons for a long-term approach is the power of compounding returns. When you invest your earnings, your investment grows exponentially over time. Buffett's own investment journey is filled with stories of long-term investments that pay off handsomely. For example, his investment in Coca-Cola in the late 1980s has yielded substantial returns over the decades, as the company continued to grow and expand its market reach. Similarly, his early investment in American Express during a crisis allowed him to capitalize on the company's recovery and growth, resulting in significant profits. These examples illustrate how a long-term investment mindset can lead to remarkable financial success, reinforcing Buffett's philosophy that patience and perseverance are key to wealth creation. Learning from mistakes. Learning from investment mistakes is a vital aspect of becoming a successful investor, and Warren Buffett is a prime example of this principle in action. Throughout his career, Buffett has made several notable errors that have taught him invaluable lessons. One such mistake was his investment in Dexter's Shoe Company, which ultimately resulted in a significant loss. Buffett later admitted that this misstep taught him the importance of understanding the competitive landscape and the long-term viability of a business. These experiences have profoundly shaped Buffett's future strategies. He emphasizes the need for thorough research and due diligence before making investment decisions. By reflecting on his past errors, Buffett has developed a more disciplined approach, focusing on companies with strong fundamentals and sustainable competitive advantages. This evolution in his investment philosophy highlights the importance of adaptability and continuous learning in the world of investing. For viewers, embracing failure as a learning opportunity is crucial. Every investor will encounter setbacks, but the key is to analyze what went wrong and apply those lessons to future decisions. By adopting a growth mindset, you can turn mistakes into stepping stones for success. Remember, even the most successful investors, like Buffett, have faced challenges, and it's how you respond to those challenges that ultimately defines your investment journey. Stay informed and educated. Continuous learning is essential for anyone looking to succeed in investing, and Warren Buffett exemplifies this principle. He is known for his voracious reading habits, dedicating several hours each day to consume a wide range of materials. Buffett often reads annual reports, financial news, and investment-related books to stay informed about market trends and economic developments. This commitment to education allows him to make well-informed decisions and adapt his strategies as needed. For viewers, embracing a similar approach can significantly enhance your investment acumen. Reading books and articles on investing not only broadens your knowledge, but also exposes you to different perspectives and strategies. Classics like The Intelligent Investor by Benjamin Graham and Common Stocks and Uncommon Profits by Philip Fisher are excellent starting points of understanding fundamental principles of investing. Additionally, staying updated on market trends is crucial for making informed investment choices. Understanding economic indicators, industry shifts, and consumer behavior can provide valuable insights into potential investment opportunities. By actively engaging with financial news and analysis, you can better navigate the complexities of the market. If you want to know more about the path to prosperity, check out the video here and see you there.